everyone, welcome back to Conviction Bet. Hope you're doing well. As I'm recording this, the S&P 500 is hovering just below 7,600, near record highs after one of its strongest runs in months. Even as a wobble in the big chip names this week reminded everyone just how much of this rally is riding on artificial intelligence. At the same time, oil has been whipsawed by US and Iran headlines. The latest inflation data came in near its hottest pace in almost 3 years, and the bond market has started to take seriously the possibility that the Fed's next move is a hike, not a cut. So stocks are still acting like the sun is out, and the plumbing underneath is flashing yellow, which honestly is a pretty good setup for what I want to talk about today. And speaking of things that should have moved the tape, this week, the European Central Bank put out its annual reserve report and confirmed something genuinely historic. Gold has now passed US Treasuries to become the single most held reserve asset on the planet. So let me get this straight. A rock that pays no interest, generates no cash flow, and just sits in a vault has now out-reserved the full faith and credit of the United States government. And the stock market hit a record high the same week. But here's what actually matters. $39 trillion in federal debt. $1 trillion a year in interest. More than the entire defense budget. The United States lost its last AAA credit rating. And the market didn't blink. The market is telling a story about artificial intelligence and record highs and how nothing can stop this rally. The real story is about something much quieter, the slow, steady repricing of trust in the asset the entire financial system treats as risk-free. I'm JL Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. I'm going to make the case that the United States is early in something Ray Dalio calls the big debt cycle, that the cure for it is mathematically simple and politically brutal, and that the bond market is already keeping score even though the stock market is looking the other way. And by the end, I want to convince you of something uncomfortable, that the one asset everyone calls risk-free may be carrying more risk than anyone wants to admit, and that the highest returning asset you own isn't in your portfolio at all. So let's start with the number, because it has a way of going numb the more you look at it. Gross federal debt crossed $39 trillion in March of 2026. That's about 123% of everything the U.S. economy produces in a year, and it's growing by something like $6 billion a day. By the stricter measure, the debt actually owed to outside lenders rather than to the government's own trust funds. The country crossed 100% of its economy earlier this year for the first time since the Second World War. The deficit is running near $1.85 trillion, which works out to spending about $1.33 for every single dollar it collects in taxes. And the interest bill on all of that has now crossed $1 trillion a year. Sit with that one. The United States now spends more servicing its debt than it spends on its entire military. More than it spends on Medicare, too, back in 2017. That interest number was $263 billion. It has roughly quadrupled. And Moody's expects it to swallow about 30% of all federal revenue by 2035, up from 18% in 2024. And there was a moment last spring when all of this was supposed to land. In May of 2025, Moody's downgraded the United States, stripping away its last top-tier credit rating. Standard & Poor's had done it back in 2011. Fitch in 2023. Moody's had held America at the very top since the era of the First World War. And now the country that issues the world's reserve currency carries a AAA rating from exactly nobody. The market's response? Record highs within days. One economist called the downgrade, quote, non-news, dryly already priced in. In fact, in that same stretch, Alphabet announced plans to raise $80 billion to pour into its artificial intelligence build-out, with Warren Buffett's Berkshire Hathaway putting $10 billion behind it. Capital is rushing into the future at a furious pace, even as the ground the whole thing stands on quietly cracks. And I want you to sit with how strange that reaction actually is. A downgrade that moves no prices is not proof the problem is harmless. It is proof the problem is slow. And slow problems are the dangerous ones for investors because they punish the people who mistake the absence of a crash for the absence of a trend. So here's the way I want you to picture the whole thing. Think of a country's debt like a credit card, except this particular cardholder also owns the company that prints the money. So it never has to technically miss a payment. In the normal run of things, every bond gets paid in full, on time, in dollars. It just quietly arranges for those dollars to be worth a little less. If you take one thing from today, a government that borrows in its own currency rarely goes broke the way a family does. It goes broke the way a currency does. Now, this is Ray Dalio's framework, and it's the spine of his book, How Countries Go Broke, which was a #1 New York Times bestseller last year. He studied 35 cases over the last century where governments effectively went bust, and he found the same arc almost every time. He calls it the big debt cycle, and it runs roughly 80 years, about the length of a human lifetime, which is part of why it keeps happening. The people who remember the last reckoning are usually gone by the time the next one builds. It starts virtuous. A young country borrows, invests the money in things that actually make it more productive. Roads, factories, schools, the economy grows, the tax base grows, the debt gets paid back, and everyone wins. But borrowing is always politically easier than discipline. A war, a recession, a pandemic, a bad harvest, each one becomes a reason to borrow rather than to cut, because telling voters to tighten their belts is about the closest thing there is to political suicide. So the debts that were each supposed to be temporary just stack one crisis on top of the last. And the politics make it almost self-reinforcing. An elected government thinks in 2- and 4-year cycles. The official who borrows today gets the reward today, the road, the bailout, the tax cuts, while the bill lands on some future administration that might not even be the same party. So the rational move nearly every single time is to borrow and hand the problem forward. Multiply that by a few decades, and you arrive exactly where we are now. And here is the part that matters most for you. When a normal household can't pay its bills, it defaults. Full stop. But a government that prints its own money has a third door that you and I don't have. It can have its central bank create brand new money and use it to buy its own debt. That is not a missed payment. That is debasement. The bill arrives, more often than not, as inflation, and it gets spread silently across everyone holding that currency or any bond denominated in it. Now, we've all seen the cartoon version of this, Weimar Germany, a wheelbarrow of cash for a loaf of bread. That is not what I'm describing. The realistic version is far quieter. 2, 3, 4% a year, every year, where your dollars just buy a little less each time and nobody ever rings a bell. But compound that quietly over a decade or two, and it's the difference between a comfortable retirement and an anxious one. Which brings us to the single number that actually governs this entire cycle. The interest rate, because strip away the jargon, and a bond yield is just the price a lender charges for trust, for the belief that they'll be paid back in money that still buys something. Low trust, high rate, and trust is the one input a government cannot print. So what does that mean for you sitting there with a portfolio? It means the danger here isn't some dramatic default you'll read about in a headline one morning. It's a slow erosion that lands hardest on the things that feel the safest cash, in ordinary government bonds whose payments are fixed in the very currency that's losing value. So, if the problem is this clear, why doesn't anyone just fix it? Here's the maddening part. They know exactly how. Dalio calls it the 3% solution. Take the deficit from around 7% of the economy down to about 3% a level. America last managed in the late 1990s, right before the budget actually swung into surplus. And he says you get there by pulling 3 levers, more or less evenly. Cut spending by about 4%. Raise taxes by about 4%. Get real interest rates down by about 1%. spread the pain, so no single group takes the whole hit. The Treasury Secretary, Scott Bessent, has his own version, a different 3-3-3, 3% growth, a 3% deficit, and 3 million more barrels of oil a day. Even Warren Buffett has pointed at 3% as the right number. So the diagnosis is basically consensus. The trouble is that all three levers are jammed. Take spending. The three biggest line items in the budget are Social Security, Medicare, and defense. Touch any one of them and you lose the next election. These are the most politically radioactive dollars in the entire federal government. Defense isn't even shrinking. The fiscal 2027 request would raise military spending by more than 40%. The government efficiency push spent its opening months going after the only things anyone would let it near foreign aid, a few discretionary trims, and against a deficit of nearly $2 trillion, the savings were a rounding error. You cannot fix a problem that's made of the big stuff by cutting the small stuff. Then there's taxes. And the political wind blows the wrong way. The most recent package cut revenue rather than raising it on the long-run bet that lower rates eventually grow the economy enough to make up the difference. Maybe that works over a decade. In the near term, it just widens the gap, borrowing more while collecting less. And the third lever getting rates down is the one Washington controls least of all. And this is where the live evidence is just sitting right out in the open. The Federal Reserve cut its policy rate 3 times in 2025, down to a range of 3.5% to 3.75%, and it's held there since. The president has been loudly demanding more. And yet the part of the curve that actually finances the debt, the long end, has flatly refused to follow. The 10-year Treasury still yields about 4.5%. The 30-year is up near 5%. Both of them higher than where they sat when the cutting even started. Here's the mechanism. The Fed sets the overnight rate. The market sets the long rate. And right now, investors are demanding the most extra compensation to hold long bonds that we have seen since 2011. That premium is their way of saying they want to be paid more for the risk of locking up money in a borrower that just keeps borrowing. Some corners of the market have flipped from pricing cuts to seriously pricing hikes. Traders are now roughly split between no move at all and at least one hike by year end. And it gets worse mechanically. A big chunk of this debt is short term. It has to be rolled over constantly, refinanced at whatever rate the market demands that week. So even if rates simply stay where they are, the average interest cost keeps grinding higher because cheap debt issued back in the zero-rate years keeps maturing and getting replaced with expensive new debt. The interest bill is on an escalator, and nobody's hand is anywhere near the button. The government can lean on the printing press all it wants. It cannot command the price of its own credit. So here's the so what, and it's a big one. If your plan quietly assumes that long-term rates will fall and rescue the value of your bonds, the bond market is telling you in real time not to count on it. So, if the politicians can't or won't act, what are the people whose entire job is to manage risk actually doing with their money? Don't watch the stock index for this. Watch the most conservative institutions on earth. Watch central banks, because they are buying gold in serious size, and they have been for years. More than 1,000 tons a year from 2022 clear through 2024, around 850 tons last year. That is roughly a quarter of everything the world's gold mines pull out of the ground in a year. And it has reshaped the global reserve system in a way that's genuinely without precedent. That European Central Bank report I mentioned at the top, it found that by the end of 2025, gold had climbed to 27% of all official reserves, up from 20% just a year before passing US Treasuries, which slipped to 22%. And this matters, that jump came as much from gold's price soaring as from the buying itself. The European Central Bank was blunt about it. Value everything at 2023 prices before gold's run, and US Treasuries would still be sitting on top, with gold down at just 16%. So this is as much a story about gold's price exploding higher as it is about central banks actively dumping treasuries. The metal crossed $4,000 an ounce for the first time last October, and it's been trading near $4,500 as of early June. Meanwhile, the dollar's share of foreign exchange reserves has drifted from about 71% back in 1999 down to about 56% in the most recent IMF data. And the dollar itself had its worst first half in any year since 1973. And here's the detail that should really make you pay attention. Normally, gold struggles when interest rates are high. Why hold a rock that pays you nothing when a treasury bond will pay you 4.5% to wait? But gold has been climbing anyway, straight through the highest real yields in years. When an asset stops obeying its own oldest rule, that's the market telling you it's pricing something else entirely. And what it's pricing here is trust. And there's a clean catalyst for the moment this turned from a slow drift into a real trend. In 2022, Western governments froze about $300 billion of Russia's reserves. And every central bank not aligned with Washington learned a lesson in roughly 5 minutes. Your dollar reserves can be switched off. Gold can't. Physical gold sitting in your own vault has no issuer standing behind it, and it is far harder to freeze than a bank account or a treasury holding. It can't be printed, and it can't be switched off with a sanctions order. That is the entire point of it. And if you think a reserve currency can't lose its crown, look at the history. The British pound was the world's money for the better part of a century until it wasn't, until 2 world wars and a mountain of debt handed the crown to the dollar. The Dutch guilder, before that, every incumbent felt permanent right up until the moment it didn't. Dalio's point is not that the dollar is finished. It's that reserve currency is a status a country earns and can lose, not a law of physics. Now, the United States is not the only patient in this ward, and the 2 other big cases are worth a minute because they bracket where America itself could go. Japan is the optimistic version proof of just how far the printing press path can stretch. Its debt is around 230% of its economy, the highest of any major country on Earth. And it carried that load for years without a crisis, for 2 reasons. The debt is owned mostly by its own citizens and institutions, and its central bank stood ready as the buyer of last resort, pinning interest rates near zero for most of a decade. That's debt monetization, run patiently and deliberately. But watch what happens the moment they ease off. The Bank of Japan has started raising rates and shrinking its bond holdings, and the 10-year Japanese government bond, which sat near zero for a generation, has climbed toward 2.7% and touched 2.8 in May, its highest since 1996. The 30-year just broke above 4% for the first time in history. Japan's lesson is not that 230% is fine. It's that a captive central bank can postpone the reckoning for a very long time, and that the day it stops, the market reprices trust all at once, and with a vengeance. And Japan isn't just a cautionary tale happening safely on the other side of the world. It's wired directly into the US. Japanese investors are the largest foreign owners of US Treasuries, holding more than $1 trillion of them. When Japanese bonds finally pay a real yield again at home, a lot of that money has a reason to pack up and leave, which tugs American long rates higher right alongside them. The patients in this ward share a bloodstream. France is the cautionary version because it has no printing press at all. Inside the euro, it simply cannot create money to cover itself. So the discipline comes straight through the bond market, and faster. French debt is around 117% of its economy. The deficit is near 5%, and one government after another has collapsed, trying and failing to pass a budget that closes the gap. The thermometer everyone watches is the gap between French and German bond yields, and it keeps widening as the rating agencies circle. And if you want to know how fast a bond market can break a government with no printing press, just remember the United Kingdom in 2022. A budget the market hated triggered a revolt that ended a sitting government in about 7 weeks. So put the 3 side by side, and America snaps into focus. It has Japan's escape hatch it can print, but it's drifting toward France's problem, a structural deficit that no political coalition will close. The one thing that has spared it either fate is the dollar's reserve status. And that, as we just saw, is exactly the thing gold is quietly chipping away at. So the so what here is simple. The smartest, most risk averse money on the planet is already hedging the foundation of the system. That is not a forecast of collapse. It is what hedging trust looks like in real time. And I know exactly what the bear case is. The bear says this is the trade that has bankrupted pessimists for 40 straight years. Betting against US debt is a graveyard. The dollar is still the deepest, most liquid market in the world. There is no serious alternative to it. And a sovereign that borrows in its own currency can never actually be forced to default. The only real limit it faces is inflation, not insolvency. So what looks like a slow motion crisis is really just reserve managers prudently diversifying by a few basis points a year. And there's a genuinely new buyer the doomers tend to ignore dollar stablecoins. Thanks to a new US law, these crypto dollars now have to hold their reserves in cash and safe, short-term US government debt. And the issuers have already become some of the largest buyers of treasury bills on the planet, a fresh, automatic, growing bid for US government debt. And to really make the bear's case for them, Dalio's own famous all-weather portfolio, the one engineered to survive every kind of economic weather by leaning heavily on long-term government bonds, got absolutely hammered in 2022 when rates spiked. And look, all of that is fair. Some of it is probably right. And if you've owned US Treasuries for the last few decades, that very skepticism has quietly paid your bills. I am not asking you to throw it out. But here's why I think the thesis survives it anyway. Because the thesis was never collapse. The bear is knocking down a wall I never built. The thesis is repricing. And the inflation limit the bear just named, that is not a rebuttal. That is the mechanism. Inflation in a cheaper currency is precisely how this bill gets paid. And that new wave of stablecoin demand, it's real, but most of it naturally flows into cash and short-term treasury bills, the front end of the market. It helps the bill market. It does much less for the 30-year bond, which is exactly where the repricing is happening. It shores up the part of the curve that was never the problem. And a repricing is exactly the kind of thing you hedge cheaply rather than predict precisely. You don't have to believe the dollar is going to zero. You only have to believe that the asset everyone calls risk-free is carrying a little more risk than it used to. And the bond market, the gold market, and the world's central banks are all right now telling you the same thing. So let's bring this all the way back to what it actually means for you. I am not here to tell you to sell everything and bury gold coins in the backyard. The practical takeaway is much calmer than that. Dalio's whole idea is to own things that don't all rise and fall together, to spread your bets across the different kinds of economic weather so that something in the portfolio is always working, whether growth is speeding up or slowing down, whether inflation is running hot or cold. And here's why that matters more than it sounds. Most people believe they're diversified because they own, say, 60% stocks and 40% bonds. But stocks swing so much harder than bonds that in a portfolio like that, they quietly drive something like 90% of your ups and downs. You feel diversified. You're really just making one big bet on stocks with a little ballast taped to the side. Dalio's insight was to balance the actual risk rather than the dollars, and to always own something that does well precisely when the thing everyone else owns does badly. And the specific piece that's relevant tonight is a modest sleeve of assets that tend to hold their value when paper money doesn't. Gold, hard assets. Inflation-linked bonds, which actually pay you more when inflation runs hot, and which, tellingly, weren't even part of the original all-weather recipe. Not as a bet that the world ends. As insurance. And here's the thing about insurance. The time to buy it is while the sun is out. The insurance you go shopping for in the middle of the storm is either unaffordable or it's simply not for sale anymore. Right now, with stocks at record highs, the sun is out. And this is the unglamorous part. It only works if you actually do it. The discipline is to add the insurance when it feels least necessary. when stocks are ripping, when gold already feels expensive, when every instinct says just ride the winners, because that is exactly when it's cheap. The investor who waits until the headlines finally agree with them is the one who pays full price for the umbrella in the middle of the downpour. And if a credible plan to actually close the deficit ever shows up, if the interest bill stops growing faster than revenue, if that long bond premium starts to fade, then the insurance has gotten expensive and you won't need it. None of that is visible yet. And there is one more asset, honestly, the single best one, and it's not in any brokerage account. Remember the credit card that owns the printing press? A country's only real way out of this cycle was never a clever trade. It was becoming more productive, earning its way out. And the exact same thing is true for you. The asset that holds up best when money is being debased is your own adaptability. A person whose skills stay in demand, whether the economy is booming or breaking, in inflation or in recession, the entire AI transition included, owns the one hedge that compounds, can't be sanctioned, and never needs rebalancing. So manage your own debts the way you'd want a country to manage its own. Borrow only when it buys you something that genuinely makes you more productive, and never $1 past the point you could still service if the weather turned. Because in the end, a government never has to stand up and announce that it's broke. It just quietly makes the money worth a little less, and it quietly hopes you're staring at the stock market instead of the bond markets. Your job as a serious long-term investor is to be looking at both. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's quietvelocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.